Hello students. For more videos, press the like button and do subscribe this channel. So, in the previous video, we have seen the features of a capital structure. What are the characteristics of capital structure we have seen. Now today, in this video, we are going to look into the theories of capital structure. This is the important topic under the capital structure. So, theories of capital structure. We always know that objective of a firm, always it will be directed towards the maximization of the value of the firm. We need to find out the value of the firm. Our value of the firm should be at maximum level. So always this capital structure decision, you are taking a decision regarding the capital structure, right? This much equity and this much debt. So that decision, it will be examined from the point of view of its impact of the value of the firm. So under this capital structure theories, we need to find out the value of the firm. We have to give importance to the value of the firm. So let's see the assumptions. What are the assumptions they have gone through for finding the value of the firm under this theories? The first assumption is firms use only two sources of funds. As we know that there are different sources of funds. So exact meaning of capital structure itself, it's the different sources of funds. We know the different sources of funds like equity, debt, bank loan, debentures, retained earnings, preference share capital, so much of sources of finance we know. But according to this capital structure, we're going to concentrate only on the two sources of funds, that is equity and debt. So there is no place for retained earnings and other preference shares at all. Okay, so we're going to concentrate only the two sources, that is the equity and debt. That was the first and primary assumption. And the second thing is, there are no corporate taxes, but this assumption was removed later. So sometimes without corporate tax we will be finding the value of the firm, and with the corporate taxes we will be finding of the value of the firm. So it was removed later, this assumption. And the third one is dividend payout ratio is 100%. So that means there is no retention part itself. Retention means some of the amount from the profit will be taken as a provision. So what the company will do always from the profit, so they will be taking some amount and keep it aside for future expectations or future financial needs. But in the concept of capital structure, there is no process like that. All the profit, all the residual earnings, whatever the earnings earned by the company, all the earnings will be distributed as a dividend. So only it's mentioned 100% dividend payout ratio and 0% retention ratio. And the fourth one is cost of debt is less than the cost of equity. Since we are concentrating the two sources, that is equity and debt, we are going to prefer the debt. The company is going to prefer the debt. Why? Means the debt cost is very cheaper than the cost of equity. Why it was cheaper? Means it was there will be a more expectations from the point of shareholders. So the expectation, if it is high, means the expenses related to the equity also will be very high. So we are going to prefer a cost of debt. So cost of debt is expressed as KD and cost of equity is expressed as KE. So this was the one of the assumption. And the next assumption is no change in investment decision of the firm. So that is no change in your total assets. The total value of assets never going to be changed. For example, if your company is in a need of rupees 20 lakhs, So what will be the proportion of the capital structure? 10 lakhs equity and 10 lakhs debt. But your 20 lakhs, the total assets, the total financing, whatever the total capital employed into your business is never going to be changed. Or either you can choose 15 lakhs debt and 5 lakhs equity. So this is your capital structure. So whatever your capital structure, you can fix or you can take a decisions related to the equity proportion and the debt position, but the total will never be changed. Next, the same, the total financing, it's nothing but the total capital employed will remains constant. And EBIT, the full form of EBIT is earnings before interest and tax. The pure earnings, the pure incomes from your operation is nothing but the earnings before interest and tax. It is always expected to grow. That means there is no losses at all. Always EBIT is in a favorable situation. So this was one of the assumption. Business risk is constant and it won't affected by the financial mix. Of course, there is a business risk. Business risk is there. When we are doing an operation of a business, there is a business risk. We can't tell that there is 0% risk. Risk is there. We have to met out. Okay. So, and it won't affect the financial mix. It won't affect your equity and your debt proportions. And the next assumption is, investors have the same subjective probability distribution of expected operating profits of the firm. Same subjective profitability. So whatever your capital structure, it will expect the same operating profits. Operating profits is nothing but the EBIT. So that is remains constant and it always expected to grow. And perpetual life of the firm. So there is a constant term in your company. There is a continuous flow of your business. So there is no closure at all because of the strike and because of the lockdown, because of the lockouts of a company. So it will be a continuous. This operation will be a continuous according to your capital structure. So these are the things you have to be assumed when you are fixing your capital structure decisions. Yes. So these are the main assumptions of a overall capital structure. So capital structure theory means we simply going to relate three main things. One is leverage. Leverage is nothing but the debt content in your capital structure. So both equity and debt, it's nothing but the leverage. And the cost of capital. So for the debt, you will be mentioned KD, and for the equity, there will be a cost that will be expressed in KE, and your main value of the firm. So these things can be analyzed and can explain in different ways. There are four approaches in the capital structure theories. So those four approaches will be seen in the next video. I hope you all understood this capital structures assumptions and what the relationship of these three items. Thank you all.